Markets have continued to trade in a tight range this week, and indeed they have done for most of 2011. If we look at the FTSE 100 chart here, just looking at this from the point of the arrow right across to today, you can see that we've traded very tightly between 5,800 in the FTSE and 6,100. The only blip outside of that range came with the Japanese earthquake, which caused clearly a fall off in markets, but that was soon recovered. But clearly this tight range of markets is meaning that volatility is hitting new lows, not something we see as sustainable long term, and therefore we'll be watching markets with increasing intrigue over the next few weeks for which direction it will break out. But certainly the guidance at the moment is that despite what is clearly still negative news on some fronts, the market seems to be perfectly capable of absorbing this news. Let's take a look at one piece of bad news that came out this week. A bit of a flatline chart, but this is the Japan GDP. And what this revealed this week is that Japan has gone back technically into recession by having 2 quarters of negative growth. This line here is the 0% level, and as we can see here, the second quarter. Now this number did surprise analysts. Whilst it could be expected and widely expected they would have a difficult quarter with the earthquake, that earthquake appeared literally towards the end of the quarter. It was only 20 days before the end of the quarter, and I think this number was about twice as bad as analysts had expected. And it just begs the question that literally 22 years into their own recession and their own quantitative easing program, that they're still suffering such anemic growth within Japan at the moment. But saying that, we also returning closer to home in the UK, we had better retail sales data. The retail sales number did come in higher than expected, largely buoyed, we suspect, by good weather, royal weddings and more bank holidays during Easter. So we're not reading too much into that one piece of data. In fact, I think it's likewise in March we had a poor set of numbers, and this broadly equalled things out. But on the high street we did hear that Mothercare are removing about a third of their UK stores. That doesn't appear to have affected the property companies. I'm going to highlight Land Securities here as a company that surprised very much to the upside this week. You can see that very sharp re-rating in stocks, which surprised me. I think that property companies should be reasonably easy to analyse as a result of the data that comes out on a very regular basis about property prices, particularly in the London market. But Land Securities saw net asset value increase by 18%, and again that was well ahead of market expectations, and they had some positive comments, so that sent the commercial property sector up. And again, looking at that chart over 12 months, you certainly wouldn't be looking at any problems with the commercial property space at the moment, despite many comments to the contrary in the press. I'm going to have a look at BP again, because this stock is providing further intrigue for me. It's been a massive underperformer, as has been widely commented upon, and indeed really just over the last few days it has continued to sort of hit new relative lows, particularly against its other companies like Shell, for example. But a recent bit of news suggesting that one of their partners on the oil field is now going to place £1 billion into the coffers, maybe the first sign of sharing the burden with other partners of BP. So we've seen 2 buy notes this week. Merrill Lynch have upgraded, Investec have upgraded, and there's some momentum behind BP at the moment. We've always been identifying over the last few weeks about the value that's there and the discount rating against the sector, but it does feel now as if that traction is well underway, so that share price is beginning to provide some momentum going forward. One other sector that I want to look at is, or pertinently, one other type of thing to look at for investors is identified here by Lamprell. Now this is a mid-sized company, not a large company, but you can see a huge spike in the share price that was seen this week, and that came off the back of Lamprell buying another business, quite a big business, which would provide consolidation in its marketplace. This company is an oil services business. Large amount of business is based in the Middle East, and they're buying out a competitor and locking the two businesses together. They do expect plenty of synergies. They're financing the business through a rights issue and some debt. And the key here is that earnings per share are expected to be substantially enhanced. Now, over time, I've seen these acquisitions as opportunities for quite material re-ratings on stocks, and I'm normally looking at these things very early to see whether there is a chance for a material re-weighting. Institutions tend to like bigger businesses to invest in, so acquisitions help on that front. So not only do you get the benefit of the earnings re-rating, but you also do see price to earnings ratios go up on the back of it. And another example of that, just to give an indication of the level of re-rating that can sometimes be seen in these type of deals, was RPC Group. They completed their acquisition in March, and you can see there the stock price was around 240, and there's been about a 30 to 40% re-rating on the stock that has been seen at that time. So really just a theme that's developing. We're starting to see a little bit more M&A activity. There's certainly finance available for that, and some material re-ratings of stock prices can be seen on the back of those sort of deals.